Last week was jobs week. This week is inflation reading week again. So later this week, we're going to have the CPI and the PPI. So consumer price index and producer price index. That's a CPI, of course, measures mostly urban areas, but the consumer inflation measurement, and then PPI measures producer inflation. In other words, wholesale inflation levels. So let's talk about this a little bit. What do we expect to see later this week? Well, unfortunately, it's going to be a mixed bag. I think the headline number is going to come in higher. So we're going to see inflation look like it's increasing by 1/10 or 0.2% on year over year readings. Why do I say that? Well, here's why. Because the number we're replacing, this July number, right? For the August report, well, the report coming out here in August is for July, and it's going to be replacing this number from July 2022, in which there was no inflation. In fact, we were slightly negative on inflation last July, believe it or not. There was no inflation that month, according to the CPI. So to replace that number with something even lower than that, even a more negative reading, highly, highly unlikely. Okay, other months, of course, that we've been replacing 0.4% here, 0.2 here, 0.4, 0.3, over the year-over-year reading. So we've seen that headline number gradually come down now to 3% as of last month. I would not be surprised to see it say 3.2% or 3.1% or maybe even 3.3%. Hopefully not. But that number will spook markets a bit. And of course, the Fed will be watching it. Now, they will not be watching the headline CPI as closely as they'll be watching the core CPI. That's their favorite measure of inflation because it strips out food and energy, which they deem as too volatile. So what can we expect here? Well, here's the good news. The core CPI probably will show a decrease, okay, because we're replacing this July 2022 number of 0.3% inflation that month. Is likely to be in this 0.1, 0.2 replacement. So we could see the core CPI drop by 0.1%, maybe 0.2%, which is good news. The Fed will be watching that. However, the big question is that fast enough to satisfy the Fed? And what else will they be watching? And what else will affect the core CPI? Let's talk about that for a minute here as well. So another piece that affects the CPI is shelter. The shelter component of CPI is like 43% of the entire reading. Now, this is always a lagging indicator because it takes time for people to get out of leases and then, come up with new leases, enter into new lease agreements to show leases going down. So in most of the urban areas, I'm tripping over myself here, urban areas in the country, we have seen this lagging indicator see rents and rent equivalents drop. They have been going down. So we would expect to see this continue, or at least not go up very much, but continue in the same range, which will help that core number. Over time, this lagging shelter piece, which is such a huge piece of the puzzle, will continue to drop, or should, which will continue to help the core CPI and the headline CPI drop. Okay, so let's talk about this for a minute. There's a couple of different measurements, right? So we have this consumer price index, right, that measures mostly urban households and how inflation affects them. There's also something called the PCE, which measures the more of a broad measurement across the entire country when it comes to inflation at a retail level or a household level. This is personal consumption expenditures is what PCE stands for. And as you can see here, I'm showing you the chart showing what we've been replacing every month on those year-over-year numbers. Again, July 2022, pretty low, 0.08%. Going to be pretty tough to top that with the PCE. In fact, it didn't, right? The PCE came out, the PCE for July will be coming out at the end of August. It takes them longer to aggregate that data, to collect that data. But that's going to be a pretty tough number to get below for July 2023. So again, we could have tough sledding this month with the July numbers because we're replacing such low numbers from July 2022. Here's some interesting stats for you. I'm going to move myself out of the way here. But if you wanted to get the core PCE down to 2%, which is what the Fed's target is, remember, they're trying to get the core PCE and the core CPI down to that 2.5 range. That's where they want it. That's where they feel comfortable that we're not, stuck in an inflationary environment that's going to erode the value of our money too much over time. It'll still erode it, but just not as much, right? So to get the core PCE down to 2% on a year-over-year average, the monthly reading is actually going to have to average about 0.16. As you can see on this chart here, there's nothing that's been at 0.16 except for July 2022. Everything else has been quite a bit higher. So what does that mean? Well, let's talk about this other statement I have on the bottom of the screen. For June 2023, The core PCE decreased from 4.6 to 4.1% year over year, which shows steady improvement, right? This was the reading we got last week for June, but it's still far above the Fed's 2% rate, which explains, if you've been paying attention at all to any financial news, you're probably starting to hear some of these Fed governors come out and say, hey, we may need more rate hikes. They're starting to add an S to it now this week and last week. Not good, right? Everybody thought July was hopefully it, or maybe September would be the last one. Yeah, we may have more hikes in store because the Fed is scared to death of becoming the 1970s Fed. The late 1970s saw the Federal Reserve hike rates, and then when they thought they saw inflation cooling, they'd drop, or they'd stop rates, and they'd actually pull them back a little bit, and then inflation spiked up again. So they couldn't ever control it. It was just seesaw, zigzag, upwards, right? Where they just could not control inflation. This Fed, and Jerome Powell in particular, as the Fed chair, does not want to go down in history as another 1970s Fed. They are determined to kill inflation. So I would not be surprised at all to see interest rates continue to be increased by the Fed, which will, of course, provide upward pressure to interest rates on the long end of the curve, mortgage rates, and continue to push interest rates higher, or at least keep them in these somewhat elevated levels that we're at now. Historically, it's not that elevated, but around 7%. And, you never know. We may be pushing towards 8% by the middle of the winter. It's very possible. But the Fed is determined at this point to get inflation down to that 2% level. They've got a ways to go. So that's what I wanted to show you. Let me show you the charts real quick for today and what's happening. As you can see, the universal mortgage-backed security is down a bit on the price. That's not good for rates, right, when it's down, but it's not bad. We had quite a few gains. Let me scroll up here. We had a huge gain last Friday, right, because the jobs numbers came in weaker. Most of the job gains were part-time job gains, not full-time job gains. So the headline, even though it was lower than expected, right? So the BLS report came in like 187,000, I want to say 185,000, lower than the 200 plus thousand that the government was expecting for new job gains. And on top of that, most of those job gains were part-time jobs. So that does not indicate a super strong environment for hiring, or the economy seems to be weakening a bit. So these Fed hikes are having an effect. They're just not having an effect as quickly as the Fed wants. So we have an impatient Federal Reserve. Problem with that is they could go too far with rate hikes, tip us into a severe recession, which would affect everything, including housing and house appreciation, etc. So far, as you know, there's not enough supply to meet demand, so prices and appreciation have remained strong. We'll probably should see over 5% easily appreciation this year in the housing market here in the Boise area and across the country in most areas, just because there is a lack of supply, right? So what we've seen here is an improvement in universal backed mortgage securities. It decreased this morning, kind of lost a little ground from Friday. We're not quite back up to where we ended the day, but hey, at least we made up some of the ground from this huge dip. We're still, unfortunately, far below where we were. We're a good 0.5% lower in interest rate than where we were 3 weeks ago. These other two green candlesticks here were the last time we had inflation readings, and they came in lower than expected. So we had a great improvement, right? We had an improvement of about 0.25% to 0.5%, depending on the loan product. In interest rates, we're seeing some improvement here because of last Friday's jobs report, but I'm not expecting us to see these big green candlesticks later this week after we see the inflation reports, because it's going to be such a mixed bag. So that's the update for this week. Have a good one.